All right, so guys, you are welcome to a lecture on changes in group structure. Now, what I'm going to do is that I'm going to use this video as a part one, then in part two, we pick up two questions, then we will deal with it. Now, in terms of changing the group structure of a company, we have a typical example of acquiring a subsidiary, because if you are there, you are alone. If you buy a subsidiary, there are two scenarios that happen, and we need to look at those two scenarios. So we have one. Let's talk about acquisition of a subsidiary. All right, so when it comes to acquisition of subsidiaries, there are basically two scenarios that we see there. So let's look at the two scenarios. So we have scenario one, and of course, inside the two scenarios, one has been dealt with in the basic consolidation. So we have two scenarios. Scenario one is about a media acquisition. A media acquisition. All right. Then scenario two, we'll be looking at step acquisition. So that which was seen in the complex group, the D shape, one of the D shape diagram. All right. So we will look at step acquisition. So let's pick these things one by one and try to deal with this. All right. So first of all, we look at the media acquisition. Now for the media acquisition, we've gone through it. So we just going to refresh ourselves by looking at a past question. So let's look at the past questions in November 2016, our very first past question from ICA. All right, so it says that below are the separate financial statements of broad and two investee companies, which also operate in the same industry. And so we have the profit or loss and other comprehensive income for the three companies, revenue, everything is set up for us. We see it here. All right. Then we also have the OCI. Then we have the non-current assets. All right. Everything is set out here. Then the equity is here. Other reserves, everything is here as we can see. And so we come out with the notes, all right? So the note also gives us additional information. It says that on March 2016, Broad acquired, all right? So since we've seen that the first acquisition is on March, let's look at our questions requirement. So it's 30th June 2016. Now, if it is 30th June 2016 and the purchase is in March, then what does it tell us? So first March to June 2016. How many months is the acquisition? So we have March, April, May, and June. That gives us like 4 months, all right, into the acquisition. All right, so that is that. So you see that it's a media acquisition. So now let's just go on to read so that we can be able to do diagram working. So which is IFRS 3 acquisition accounting. So because they bought 80%, that is it. And also it says that they use two elements: a share exchange for 3 shares in Broad for every 5 acquired, and also an issue of 100 CD 6% loan note. The share issue has not been recorded by Broadway, but the issue of the loan note has been recorded. All right, so it means we don't need to create a liability anymore. At that date, at the date of acquisition, shares in Broad Limited had a market value of 5 CDs each, and shares in Narrow had a stock market price of 3 CDs each. Broad had earlier acquired 2.4 million shares. Okay, in Shadow, on the stock market at a price of 1.5 per share on January 2016. Now, if this one is January 2016 and it is up to June, then that one is giving us like 6 months. All right. At the date of acquisition, the fair value of Narrow's assets were equal to their carrying amount, with the exception of its property. These are the fair value of 1.2 below. So take note of this, below its carrying amount. And this will lead to a reduction in depreciation charge in cost of sales, of course. It will, of 50,000. So we've been given it. All right, in the post-acquisition period. Okay, so that's fine. And it says that Narrow has not incorporated these values. All right. This value change into the separate financial statement. So we will do it. Broad's group will value all its property to current value at the end of each year. And it says that on 30th June, that's the end of the year, the value of Narrow's property was unchanged from its value at acquisition. But the non-element, as we can see, of Broad, that's the parent, had increased by 500,000 as shown in the comprehensive income. So this is a reserve issue, not a earnings issue, reserve issue. All right. And it says that sales from Narrow Limited to Broad throughout the year ended 2016 was 12 million. And it says that Narrow made a markup on cost 25. So Narrow is the one who sold. So there's a need for us to do provision for unrealized profit. And if Narrow sold, we should look at Narrow in terms of margin, not markup. So now we will have to convert this. And so it also says that Broad Limited had 2 million at cost. All right. So Broad Limited had 2 million at cost to Broad of this thing in store. So if it is 2 million at cost to Broad, then it means that it is 2 million at selling price to Narrow. All right. So that is that. Because the one who sells is a selling, the one who buys is a cost. All right. So of the inventory that these are the ones that are still in stock, basically. So, all right. Now, 5, in June, Broad sold goods to Shadow. So this one too is the parent to Shadow. That's the associate of 2 million. That's achieving a markup of 25%. All right. So that is that. And this one too, if he sold, then it's also supposed to be what? What is it supposed to be? It's supposed to be a margin, right? So if you sell, all right, then it means that you are going to get a profit. All right. So basically, that is that. You're going to get a profit. All right. So take note of that. Okay. So it goes on to tell us that, sorry, Broad's investments include some available for sale investment, which had increased in value by 300,000 during the year. This is the parent and the increase in value. All right, there's an increase in value. So if there's an increase in value, these things refers to IFRS 9. And if it says that the other equity reserves relates to this investment. Okay, so it tells us that this is another OCI item. All right, so that there's no acquisition and disposal of investments. So Broad policies to value NCI at the fair value at NCI at fair value at the date of acquisition. For this purpose, Narrow's share price at the date is deemed to be a fair representation, all right, of the fair value of the share of the NCI. It was determined at the year end that 10% of goodwill relating to the acquisition was impaired. So we are supposed to do a P&L and a balance sheet. All right. So basically, that's that. All right. So what do we do? It's a very tricky situation. I've told you that in your exams, if you see these things, don't just wait. Prepare your P&L and your balance sheet down, even before reading the question. All right. So why not do that and start fixing the figures once you finish doing it? So let's go to the P&L that we have. All right. So we will just to be doing some form of a photocopy over there. But bear in mind, there is an associate and you need to create a column for associate. And so use IAS 1 basically. Just do it. All right. So what are we doing? We are doing the P&L, and it is broad group before we even come and start our workings. So we know that we are supposed to prepare a statement of profit or loss. All right, and the question said we should add other income, other comprehensive income for year ended. In the year that we are looking at is 30th June 2016. All right, so let's just go ahead, maybe put some zeros up, then start revenue, cost of sales. You have gross profit. After gross profit, distribution. We have admin. All right, and after these things, we will definitely have operating expenses. So operating expenses, or operating profit, sorry. And immediately after operating, we have issues like investment. And so this one, we have to create, we don't have any investment here. So if there were investment in the P&L, we will say investment. And we will have another one called investment in associate. All right, and this investment in associate, what we're referring to is the share of profit of associate. All right, so basically that is it. So you can write investment in associate, or just because this thing is a P&L, you just write share of profit in associate. Because another form of investment. All right, then finance cost as usual. All right, after our finance cost, what do we normally get? Net profit. All right, after net profit, then what? Net profit before tax. Then this one is net. Then we bring in tax. Then net profit. After tax. All right, so basically that is that. Now, when you finish, what do? You can decide to share it, all right, or bring in the OCI things before you share it, okay? So whichever way you want to go with it. Of course, there is OCI in the question. All right, so you may have to bring the OCI, other comprehensive income, you put them in there. Then you get the total, then you share everything. So we will come back to the sharing, all right? So basically that is that. All right. Then what else do? You also open your balance sheet down. So we know that we are dealing with broad group. So let's go and see our balance sheet. So you see, I'm doing this thing even before touching the question. So statement of financial position. As at June 2016. So this one to say, we have our NCA, right? And the NCA, of course, this is consolidation. There will certainly be a goodwill if not, all right? If it is positive, all right? If it is negative, don't forget, it's a gain on bargain. Going to retain earnings, workings 5. I just put it here. Then we have PPE, all right? So that is that. Then we have investment. So we just repeat everything here, all right? So that is that. Okay. Then what next? We come to our current assets. So the current assets, this one, they gave it to us in total. We have current assets. And because there is an associate, you bring in investment in associates. All right, so you add them up. Then we have equity. So our equity, what do we have there? We have the equity shares, equity share capital. We have land revaluation. We have OCE, other equity, other component equity, so the equity reserve. We have retained earnings. Of course, this will come with our workings 5. All right. Then definitely we will have an NCI, which will come via workings 4. All right. So the NCL, we have 6% loan notes. Then we have our current liability. All right. So basically, that is that. Now, let's now go back and start solving the question using the notes, all right, that are there. So we come here, we set up our workings. So workings 1, we call it our group structure. So we are told that we have broad as the parent, and there is broad and narrow, right? Yeah, we have narrow. And we are told in the first note that they acquired 80%, right? So acquisition here is 80%. But what is the date? They were bought on 1st March 16. All right, and that was 4 months. Okay, so be careful. Then there is an acquisition of shadow, and that one was on 1st January 2016, and that was 6 months. And what was the percentage? If you don't do this, you are wrong, because this is acquisition accounting. You must show them. Okay, so we are told that it is 2.4 million out of what is the shares they have in shadow. You have to go to the balance sheet to get that one. All right, so where are you? So this is the equity shares. It's priced at 1 Ghana cedi, and therefore here will be 6 million. All right, so now if I do that, it is what, 2.4 over 6, and that gives me 40%. So it means they bought 40%, and that confirms the associate. All right, so you have to go through this. Then you come to your workings 2. What do we do here? Fair value of net assets of subsidiary. In this case, the subsidiary is narrow. If the subsidiaries are 10, you do for 10 subsidiaries. And we have here at acquisition, at reporting, then we have post-acquisition. And don't forget, we are doing everything in thousands. All right. So we start, and when you finish doing this, I've always told you that the outlook of this side is this thing what we learned: asset is equal to equity plus liability. And so therefore, since we are buying the equity, to be equity is equal to what? Asset minus liability. So let's first look at the equity side. What do we have for the subsidiary? We have the equity shares. All right, and since the date for this one is the end of the year, then it means that at reporting, this is what they have: 5,000. So 5,000. So there's a 0 movement. All right. So you get that one down. All right. Then what do you see? The land, there is nothing there. Other equity, there is nothing there. Then the retained earnings, there is something there. So we come to the retained earnings. All right. So since this financial statement that we are seeing is at this date, we are told that the earnings here at reporting is 9,500. So that is that, 9,500. Now, this was bought mid-year. And that is the concept we are trying to look at. It's media. And like I always tell my students, whenever the thing is a media, start dealing with it from this side. Let this side be your outlook. All right. So be careful. Be careful. All right. So now they bought it media. So this tells you that if this financial statement is 2016, June 2016, then it means that the P&L they gave us is already included. All right. It's already included at reporting. So please be careful. If they gave it to you at any other year, maybe the beginning of the year, or they normally, sometimes they will put the date, all right, here, the beginning of the year, like somewhere here. So check which date is that. If that is the beginning of the year, then as usual, you have to add to the reporting, the one they had in the current year. As we can see, our retained earnings here, the profit here after tax for this man is 6,800. So it means that if we bought it 4 months, we are looking at 6,800 4 over 12. All right, so basically that is that. So 6,800 multiplying 4 out of 12 months. And that gives me 226, it's a 67 rounded. All right, so that is that. Now, if I now check my movement, of course, if I now check my movement between this and this, all right, if I deduct, that one is giving me 7,233. In other words, you can also say that the reporting date was 9,500. And what are we doing? We are basically taking away into bracket 6,800 over 12 multiplied by 4. So here over 12. So if we have done the 4 here, it means here is actually how much? We are remaining with what? 8, right? All right. So if you are taking this, if you take this 9,500, all right, and you take out the amount. So here, sorry. So I took out 4. So here will be 12 multiplied by 4. In other words, it is what? 4 over 12, like what I did here. I'm subtracting to get this figure. So basically that is that. All right. Aside this, there were some adjustments. So I'm going to change the ink. All right. So fair value adjustment. We were told that at the date of acquisition, there were fair values adjustment. Now, I've told you that the fair value adjustment can be on asset, it can be on liability. So don't always think it's about an asset. Learn the dynamics well, all right, from the basic video. Okay, so the fair value adjustment, they said that at the date where they were doing the acquisition, there was a value. Okay, so this is it. All right, a property. So here the thing is a PP. All right, and it had a value below. So if it is below, it's a negative. All right. So now the fair value adjustment, which in this question we were given, the depreciation, we had to reverse the 50. Okay, we had to reverse the 50 because that is what we were told. All right, so the 50 should be reversed. So here, 50. All right, so basically that is what we go through and do. Of course, I also saw a PAP with the subsidiary selling. So the PAP inventory. All right, so this one, where is it? Yeah, narrow selling. So if narrow is the one that sold, and we saw that it is a margin, so we had to convert it. How many were still in stock at the date? 2 million. So basically that is that. All right, and that gives me 400,000. So it's a PAP, 400,000 PAP. All right, so basically that is that. So that is all we saw concerning the subsidiary. There was the revaluations of the assets that happened was not about the subsidiary. So we can close out our subsidiary. So if I add this side, what am I getting? Getting 1917. Side is 12,950. And I have here 11,033. All right. And please listen carefully, because the name of this figure is fair value of net asset of subsidiary, all right, at acquisition. So a question can actually give you this figure directly. It can give it to you directly, so be careful. All right. So let's now go to our workings 3. All right, we can't pick any figure yet, but let's come to our workings 3. So workings 3, what do we look at? We do our goodwill. All right, we do our goodwill. Okay, so what goes into our goodwill? We will need our purchase consideration. Is that not it? So purchase consideration, and there were 2 forms of purchase consideration we were told here. So we go back to our workings 1 here, our note 1. All right, so we are told that there was a share for share exchange. So A, we have share for share exchange. And if you remember, all you need to know is to know the shares acquired. How much was acquired? We were told that they acquired 80% of the equity share capital. So 80% of the shares. So where is our financial statement? I think it's up there. So 80% of the shares, where are you? So this is their share. Okay, it's 5,000. And the price is 1. So this is that. All right, 5,000. And that gives me 4,000 shares. All right. Then shares issued, number of parent share issued for that fault. So share issue. And we are told that how did they do it? So a share issue for 3 shares in broad for every 5 acquired. Now we acquired 4,000 shares. So for every 5, we are giving 3. And that, all right. Okay, so that gives me 2,400 shares. Now, what is the value of the share? The value of P share, the parent share. All right, but what we have, the value of the parent share in this, it says that broad is 5 and narrow is 3.5. So narrow will be used for the NCI, all right? So that is that. So in this case, what do we do? Of course, there is an issue share, so there's a rise of a share premium. We have 2,400 multiplying the nominal price, and we have 2,400 also multiplying, it was 5, so the premium of 4. So here will give us 2,400. All right, so that is that. And the other side, which is 2,400 multiplied by 4, gives me 9,600. All right, so as in when it comes to 9,600, sorry, when it comes to the share for share, what we have is a value of 12,000. Now, bear in mind, I splitted this because this is going to the stated capital from our very first basic console, and you know this will be going to share premium. All right, so if I didn't create a share premium, I'll put this one under other equity. All right, so that is that. So then B, there is another one. They said that even though it was recorded, we need to find the purchase consideration. So what they did was that they issued 100 cedis 6% no stock for every 500 shares acquired. Again, so we have the loan stock or the loan note. What happens is that, well, how many shares did we acquire? We've gotten to know of it already. We acquired 4,000 shares. All right. And for every 500 out of this, as per what the question is telling us, what they were going to do is to give out what? 100 cedis notes for that. And that, if I add it to my, so you see, this is the double entry, all right? So the credits are these and the debit is the purchase consideration we are doing. So this one too, how much will we have? Of course, this one cancels it, so 8. All right, so we have like 800. So this 800, okay, so the 800 that we have, what does it mean? So the double entry should be debit the purchase consideration and credit the liability, but the question told us that the liability side has already been recorded. So our total purchase consideration therefore is equal to 12,000 what? 800. What do we do? NCI at acquisition. NCI at acquisition. Why are we adding the NCI at acquisition? Because we did not buy every part. I keep explaining to my student that everything here is simple. It's just going to the market, paying an amount. So the amount that you pay is what we call the purchase consideration. And what you are buying, how much it costs the person, all right? How much the person is selling to you, all right? So here is your cost, how much you are paying, all right? And how much the person is selling the thing, all right? So the selling price of the person selling, okay? Selling price. Now, you see, to the person who sold to you, when his selling price exceeds his cost, what do we call it? Don't we call profit? We call it profit. That profit to the person who sold, to you who bought, is what we call goodwill. All right. So please, it's not anything dangerous. Okay. But you see, you didn't buy every part of the thing. So since we didn't buy every part of the thing, we need to subtract the part that we didn't buy. All right. And since we are going to later use the workings too, so you see here we do what? Fair value of net asset. We are less in fair value of net asset at acquisition. Now, what is the fair value of the net asset at acquisition? We had it in our workings too, didn't we? Now, the fair value of the net asset of the subsidiary is 11,033. But we didn't buy everything. We didn't buy everything. All right. And so therefore, the part that we didn't buy has to be subtracted or added back. So the concept of subtracting is that we are adding it here. That's all. That's all. So, and the question told us that they use what do we call it? Fair value. All right. So what is the part that we didn't buy? If we bought 80%, then it means we didn't buy what? 20% of one, and we are going to multiply this thing by the price they've given us, 3.5 each. All right, so basically that is that, and that gives me 3,500. All right, so the part that I didn't buy is the one I'm taking out of the equation by what? Adding it here. So if adding, you see, if I take these two figures, it means I've taken it out between this and this, because this is a negative and this is a positive. So basically that is that. Then you get what we call goodwill at acquisition. All right. So how much? Sorry, it was impaired. So goodwill at acquisition, how much does this give us? We have 5,267. Impairment is 10%, right? So 10% of the 5,267, which is 527 rounded. All right. And since the impairment, this is the fair value method, we will be sharing the impairment. So our goodwill is what? 4,740. So this is the goodwill as reporting date. So quickly, I tell my students, once you get to this point, go back and start fixing your figures, because if they were to say stop work, you will get something. All right, so go back. So come here. Let's start our P&L. So this is what we do. Revenue, 92,500 plus narrows. So we bought it 12 months, 12 over 12. We bought it 4 months, 4,800, 48,000, sorry. All right, so you start creating these things down. 7,500 plus 4 over 12 multiplied by 36,000. You have to do this. All right, distribution, 2,500 plus 4 over 12 of 1,002. We don't consolidate associates. Please be careful. So don't never do that. Never try and add them. All right. So plus 4 over 12, 2,400. Operating profit, you will be getting it. There's no investment here. So this one will come via our working 6. All right. You remember. All right. It will come via that. Okay. Then finance cost, what do we have? We have just 1,000. There is no additions to that. If there is any dividends, you know what we will do. So let's just put it here. Plus 0. Then tax, 3,900 plus 4/12, sorry. 4/12 by 1,006. All right. Our balance sheet, what do we do? Of course, we found our goodwill. So we just put here workings 3. And how much was our goodwill? $4,740. PP, what do we have? Don't forget, we've done some things in the PP already. So we have 18,300 plus 18,900, then plus the adjustments that we did. What was the adjustment? So this adjustment minus 1,002 plus 50. All right, minus 1,002 plus 50. So let me just do plus 50 here, minus 1,002. So all these things are coming from workings 2, workings 2. All right, so basically that is that. And this 50 is also going to my P&L. So the 50 here, what do we do? It was a deduction, all right? So minus 50. All right, so that is coming from workings 2. All right, so please take note of that. Take a very good note of that. All right, so basically there is also a PAP in there, and the PAP was how much? So we have a PAP here, provision for unrealized profit. Okay, so that is a takeaway from inventory. So a takeaway from inventory, which is our closing stock. What will it do? It will increase our cost of sales. All right, so that is that. That is that. So this one plus PAP of 400. So the PAP. All right, so that is that. And here, when we come to our inventory, where are you? So it is inside our current assets, right? So since it is inside our current assets, what do we do? What is the total current asset? We have 12,500 plus 2,400 minus the PAP, closing stock. All right. So how much is the PAP inside our closing stock? All right, that one too is the same 400 that we are going to use. All right, so minus 400. Okay, so basically that is that. All right. So you could do this. Go ahead and you do these things now. All right. So we come to our NCI, workings 4, NCI. All right. How do we do our NCI? Of course, our NCI, we need the NCI at acquisition. And we found out in our workings 3 that our NCI at acquisition is 3,500. All right, then NCI share of post acquisition. And how much do we have for our post acquisition? The value we have for our post acquisition, we have 20% multiplying our post acquisition. How much is our post acquisition? 1917. So 1917. All right. So how much would that give us? 1917 gives us 38300. All right. Then NCI share of goodwill impairment. Since the fair value method was used. If the proportionate was used, we won't share it to the NCI. Everything will go to the workings 5. All right. So this one is 20%, and our impairment is 527. Right. So 20% of 527.2 by 527. That one gives me 10 5.4. So rounded 105. All right. So basically that is that. Is there any other thing? Normally what comes here again will be any form of, let's say, preference shares in the subsidiary, any revaluation reserve that is also shared of the subsidiary that is shared. So we don't have those ones here. And if there were attributable attributable NCI to it will come here. We don't have all those things in the question, so we can close out this. So this one gives me 3778. So NCI carry down. So I can go straight to my NCI as well. 3778 and put it here. Workings for, I already know it is what 3778. All right, so basically that is that. All right, so I come to my workings 5, and since there is an associate, my workings 5 will be done in conjunction with the associate. So group retained earnings. So then I'll also create here working 6, which is investment in associate. So when I start here by doing parent RE, parent retained earnings. How much is the parent retained earnings? Parent retained earnings here is 12,900. But here I'll call it purchase consideration, what I have inside there. And how much did we use to pay in the investment in associates? So let's go and look for that. So you also had 2.4 million, acquired 2.4 million. And that 2.4 million, according to this question, they paid 1.5 per share. So that is what I do. So I have 1.5 per share by 2.4 million shares. And how much is that giving me? So that one gives me 3,600. All right, so basically that is that. Is that okay? That's that. Okay. So that is what we do. Then the next thing is the CI share, right? CI share of post-acquisition profit, which is 80%. And how much was that when we were sharing it here? 1917, right? 1917. And so 80% of the 1917, we have 1534. All right, so that is that. So here too, you do the same CI share of post-acquisition. How do we find the post-acquisition? Of course, is the retained earnings. So what we are doing is that CI share, which is 40%, and here you need the retained earnings at reporting minus retained earnings at acquisition. And don't forget that you are going to apply the 6 months to it because they bought it 6/12. So if I now take my 40%, what is the retained earnings for this month? What is the retained earnings? So the retained earnings, as I see here at reporting, is 7,000. All right. So, oh no, it's not 7,000. It's rather 5,000. So I'll do 5,000. All right. At reporting. Then what is the retained earnings at acquisition? At acquisition, we don't really know the retained earnings at acquisition, but because we were not giving the retained earnings at acquisition. So what do? When we go up there, you will see that there is post-acquisition profit because this is post-acquisition profit, and we can find our post-acquisition profit from here. So it means that we are just safe to actually say that 40%, and we bought this thing in 6 months. All right, this is the profit for the year. because retained earnings at acquisition and retained earnings at reporting, all right, gives us what we call profit within the year they acquired it post-acquisition. So if I can also find my post-acquisition by doing 6,800, and since I bought it 6 months, that is basically it. So what do? I do half of the 6,800, which is 3,400. Okay, so that is the post-acquisition. All right, but we have what do we call it? We bought only 60% out of we bought only 40% out of the. So this is the, what do we have? This is the post-acquisition. This one gives me post-acquisition. So what we are going to do is that, of course, we have 6/12 here. So I have 40%. Post-acquisition is 3,600. Then we bought the company 6/12. So CI share of that. All right. So now, how much do I have? How much do I have in that? So if I do this thing correctly, so you have 6,800 for the full year. All right. But the post is half, is 6 months. So that is actually 3,400. Sorry. So this one is supposed to actually be 3,400. So don't forget, it's 3,400. And this is 3,400. Then multiply by this figure. All right. So that is what we have. So basically, and so that gives me 1,360. All right. So basically that is that. So like I said, it's 6/12. That is the, oh sorry, this one shouldn't be there. So this is it. All right. That is that. So you have 40% of the post acquisition, which is 6,400. So you do that, you have this. So that is basically it. All right. So you've done that. So you come here again. What is here? So this one will come in because it is a retained earnings that you have obtained. Okay. So basically that is that. So CI share of post ac. Now it is the associate. So which is 40% multiplied by 3,400. That gave us 1,360. All right. So basically that is that. All right. The 3,400, don't forget, is the post acquisition. All right. Post acquisition. All right. So basically, that is that. That is what you go in there and you do. All right. So now, what is the remaining thing? CI share of impairment. Which is 80% of, what was the impairment? Impairment was 527. So 80% of that, 527. How much is that? 80% of 527 gives me 422. All right. There was no impairment here. If there were, you would deduct also. All right. And you bring it. All right. The same thing over here. Okay. So that is that. Then what else do we have here undone? There was a PAP between them and the associate, right? So let's go and find out that PAP. So it means we've dealt with all these notes. Okay. So sales from narrow to broad. We did that. Was 12 million. So even with this 12 million in your P&L, all you need to do is to minus here 12 million group sales, 12 million. All right. So I think this one is cool. All right. So now and also there is this This one, bro, sold. Please, this one is an associate. So, I mean, we don't consolidate associate, so it can't come here. All right. So basically, that is that. So what do we do? Associate, where are you? There is a PAP on the associate. So the PAP. So as for the PAP in associate, it is always in group workings 5, regardless of who sold to who. All right. So how are we going to do the PAP? So the PAP that we have in here, how much is the amount? All right, we have 2 million, right? Okay, so we have 2 million, and the thing they communicated to it as if it was the markup thing. All right, so what we do, we change it to margin. So by the 2 million, and that gives me 400. All right, now this 400, what happens is that we do the CI share of that PAP, the unrealized profit. So what we will be doing is this, the CI share of the unrealized profit. So this is how we calculate it for the associate. So pardon me on that. So we will multiply it by the 40% we owe inside there. So that is that. So by 0.4, which is 160. We don't take the entire part because we don't consolidate that one. All right. So since the parent sold, it will be here to CI share. If the associate is the one that sold, it will only be here. All right. It won't come here. All right. So that is that. So what do we do? CI share of PAP, provision for unrealized profit. So that is 40% multiplied by 25 over 125 by the 2 million. And that we said is 160. All right, so basically that is that. So if I now close down this side, 60 goes off. So what I will have here is 4,800. So this is my investment in associate. So quickly, I go here, investment in associate. All right, 4,800. So investment in associate was given by working 6, and therefore I put here 4,800. So this investment that we have here, of course, it was in the balance sheet. How much? 12,600. So this is what we do, 12,600 minus, don't forget, the purchase considerations that have been happening. So the associate, how much did we buy it for? For example, how much did we buy the associate for? We bought the associate for how much? 3,000. No, this is not the associate. We bought the associate for 3,600. All right, so 3,600. That's how much we bought the associate. So that's the first investment. So 3,000. Wow, have I shifted the figure? I think this figure is shifted from somewhere. I will need to find out where this figure lifted itself from. Yeah, I think it's here. All right. So you will see that there was an investment in associate for 3,600. So that one clears it off. Then again, there is a 9,000 left inside there. So where do you think the 9,000 is from? If your guess is as good as mine, where do you think that 9,000 will be coming from? Because that is not the only investment you have inside there. So you have to be very, very careful. I always tell students that always do that deduction. All right, always try and do that deduction. So you could see that after you have taken away that 3,600, the question told you about some other investment inside the financial statement. But you see, these ones that we did were for you see, this one goes to stated capital, this one goes to share premium, this one is a loan, so it has nothing to do with that investment. So it means there's a balance of investment over there. There's a balance of investments over there. All right, so you always be careful. All right, now, so what do? We were told about some other investments in the question. Okay, so we minus the 3,600. We also told about some other investments inside the question. So let's go into those investments. So the question also told us that the 800 of the other side was recorded. So we are taking off. So it was recorded in here. So basically that is that. So you have to be careful about these things. All right. So you take away your 800. So what do we have? There were other investments mentioned. So that is where you see the other ones. Question said, where are you? Where are you? Where are you? Okay, so it's like this one, for example, it says that they have, and the value had increased. All right, the value had increased. So if the value had increased, it means that we need to increase the value of this. You also saw in the OCI. So where are you? Where are you? Where are you? Quick, quick, quick. All right. So you also saw this in the OCI. So that investment that you see is going to be an increase. All right. So you see 500 here. You see an increase in that. All right. So that also will be there. There is an investment gain of 300. So basically that is that. All right. So this 3,600 is coming from our investment in the associate. All right. That is that. And also they told us the 800 we use for our purchase consideration was already recorded. All right. So it was another form of investment. So it is inside here. So if you check it out, how much are you getting? How much we are getting is exactly what we are coming to calculate and get. So we have 12,600 minus 3,600 minus 800. All right, that's 8,200 plus the increase in investment, which is 8,500. So we have 8,500 here. So basically that is that. All right, so that is it. We didn't have any other additional PAP to add to this one, right? So it was 50 minus 1,002. So when I close that down, how much am I getting? 36,050. So that is what I have. All right, so now look at my current assets. So that one too, there was a minus of PAP of 400, which was workings 5, right? The workings 5 or workings 2? Workings 2, yeah. Workings 2. All right, so that one too, if I less it out, 14,500. So basically, this is it. Basically, this is it. All right, so if I add all this total, which should be the balancing figure, I have 68, sorry. Imagine. So this is 68,590. All right, so basically, that is that. 58,590. All right, now my equity capital, we're close to done. My equity capital, what did I get? Where are you? For the parent side, where are you? 15,000. But don't forget there was a share for share exchange. Okay, so that 15,000 and the share for share exchange, how much of was our share for share exchange? Where are you? So we have 2,400 and 9,600 for, so this is 2,400. So that gives me 17,400. That not it. Yeah. So basically that is that. All right. Then the other reserve. So where I can put my share premium. Other than that, I need to create a whole share premium. So other reserve, I have 500. All right. So the 500, and you saw that the question said this one had increased by 300. So I now add my 9,600 to this, which is share premium. So this is working three. All right. So I have 800 plus 9,600, and that gives me 10,400. All right. So that is that. 10,400. The revaluation reserve to is here. It was given. That is 2,000. Retained earnings. Are we done? Are we done with our group retained earnings? All right. So these are, yeah. So these are what we have here. So we can now total the group retained earnings to find out how much we've got in there. So if I total this side, quickly, 12,900 plus 1,534 plus 1,360 minus 422 minus 160. That is giving me 15,212. So the two that I'm looking for to actually make sure this thing balance, I think, has shown up. So 15,212 because of this one. So 15,212 so that this side contains 0. NCI workings 4 is what is already there, right? So it means I need to just pick these figures up. All right, so I have my total equity side. All right, so when I total this, how much will I be getting? So what I have is 17,400 plus 2,000 plus 10,400 plus 15,212 plus 3,778. So together, all these things are giving me 46,990. 46,990. All right. So I have seven. Oh, sorry. It's 2,000, not 200. This thing appeared 200. So it's to the rival. So it's actually 48,790. 48,790. So that's what I have. 48,790. All right. The loan stock, the loan here is 3,000. The other side was dealt with at the top. All right. What about current liabilities? Current liabilities, where are you? We have 10,000 plus 6,800, right? And that gives me 16,800. So if I add plus 3,000 plus 16,800, oops, I have 68,590. So you see, I balanced this thing. Now I come here, just fixing the figures. You see, I finished everything here before I'm even coming here. So now that I've balanced that side, like it gives you some confidence to actually move to the others. All right. So here, I think I need to bring this one to this place. So let's do the side of the revenue. Okay. Let's go to the side of our revenue. So the revenue, what did we get? So there was how many intra groups? How many intra groups did we get here? Group sale. All right, so this sale, sales from narrow to broad throughout the year. The year ended 20. All right, so this is a whole year thing. So what it means is that we need to do 4/12 for this one too, because they said it's a full year. We are doing the post acquisition part is the one that we need to take out. All right, so throughout the year means that. All right, so 4/12, 4/12. So let's add it now. 9 to 2,500. 4/12 of 48,000. Then 4/12 of 12,000. All right, so I have here 104,500. I need to close this one too. This one is giving me, that's just a, so this one was 78,550, sorry. So that gives our gross profit to be 25,650. All right, so basically that is that. Distribution, and don't forget there was impairment, all right, impairment. And impairment is added to administrative expenses. Okay, so the impairment is 527. That is working straight. All right, so distribution, we have 2,900. All right, then admin. So admin will be admin gives me 6,827. All right, which means my profit here is 15,923. All right, so that is that. There was no investment, but the share of profit in the associate will come. So where are you? Share of profit in associate. How do we do share of profit in associate? We take P&L item. This is a purchase consideration. It's not P&L item, which means my P&L items, profit here is 1,360. Then I take away the PAP of 160 because we don't consolidate the PAP at the top there. So we will do it here. So this one gives me 1,200. All right, so that is that. So the share is 1,200. So investment in associate, 1,200. All right. So 1,200 plus 15,923. That gives me 17,123. Where is finance cost? I've not seen the finance cost. Okay, it's down here. 123. The finance cost, how much do we have? It will only be this, right? So minus 100. It gives me 17,027. All right, 023. Okay. So basically that is that. Then the tax to if you do, let me see, 3,900 and that is 4,43300. 4,433. So that's zeros in the end. So I have 12,590. All right. So you can decide to share this or you can decide to do the OCI part, because the OCI part, what was there? There was gain on revaluation. All right. So already there was gain on available for sale and gain on revaluation. So the gain on revaluation we had there was 500, right? The gain on revaluation is 500. All right. Then there was already an existing the gain in investment. Gain in investment. Fair value of the investment. That one was 300. That one was 300. All right. So here we have 300. Okay. So in total, how much do I have? It's like, so this is 800. So 800 would end this one to 390, and this would now be 13. All right. 13. So now let's share. Let's share. Now, when you are sharing, first you have to share the NCI separately from the you have to share the profit from, so share. So we will do the CI and the NCI for the, what do we call it? The profit here. All right, we will do that one first. Then we will do another CI and the NCI for the reserves. All right, so basically that is how we do it. Okay, so you do each one for the other. Okay, but you could see clearly that for the revaluation reserve, they were all for the CI. Okay, so the parent of the CI. So what we're going to do is that this one will have nothing, and the entire 800 as we see in here was as a result of things surrounding the CI. So we will just put 800. If it were to be any other thing that was just concerning the NCI, we will split with the NCI. Now, when it comes to this side, I've told you that you will do those ones here. So just as when you were doing the share in the associate, the same thing. So you pick those two from here. Basically, that is that. Okay. So now, how will it be? 383 minus 105. Because this is a balance sheet figure. This is not a P&L figure. So these are the P&L figures. All right. Impairment and what? Profit. So that gives me 278. So all that I need to do is to put here 278. So this is workings for, right? So 278. So if I now deduct from 13,390, I have 13,112. So 13,390. All right. No, sorry. So it should be deducted actually from 12. So this is 12,590 minus 278. All right. So it is 12. The parent will have 12,312. All right. So basically that is that. So it means here will be 12,590. If I now add it to this one, then I get this balancing figure to 13,390. So basically, this is how we go around it. All right. So that's how we do media. Now in the part 2 of our video, we are going to look at the step acquisition. All right, step acquisition. And we will pick past questions and be dealing with it. So we do step acquisition. We'll be looking at step acquisition, and we will be looking at disposal, because this whole thing, changes in group structure, is just about acquisition, which means you bought and you'll be buying extra. All right, and disposal, all right, which means you'll be disposing. Okay, so when you dispose, are you disposing everything? So we have full disposal, then we have partial disposal to lose control, and partial disposal to still have control. All right, so those are the things we are going to look at. So meet me in the part 2. All right, and let's roll with how we look at this. Thank you so much, and God bless you.